Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj Shah and you're watching Indian Open. Let's go straight to the headlines at this hour. Tapering growth rate and inflation room may prompt the 6-member Monetary Policy Committee to cut rates for the third time in 2019. India will continue to be the fastest growing economy in FY20. According to the World Bank, it expects the country to grow at 7.5% over the next 3 years, faster than China. 2 rating agencies cut DHFL's bond ratings to default after the housing finance company fails to honor interest payment on June 4th. Company says it still has 7 days to honor the commitment. And the gas regulator allows GAIL to charge more for 2 of its gas pipelines for the next 3 years. The stock remains in focus today. Well, let's take a look at the trade setup for the day. There are 2 or 3 things. There is one very big global piece, then there is commodities and what crude does, and what Diwan housing and its own sets of problems bring, in addition to, of course, all the specific stocks in use. So let's tackle them one by one, very quickly take you through what I think are the key things to monitor in the session today. Firstly, what the world markets have done, and the world markets have done well in the last 2 days. We were off yesterday, but the world markets closed well yesterday. Keep in mind the world markets were closed very well day before yesterday as well, and therefore if you look at the 3-day chart of the S&P 500 or the Nasdaq or the Dow, you will see that there has been a sizable uptrend in those markets. Yes, because of the failure of continued talks with Mexico, the futures have slipped a bit today, but the 2-day move has been positive, and that should augur well. It's a mixed bag for the rest of the Asian screen today. Yesterday wasn't a bad day for Asia. Today it's a bit of a mixed bag for the Asian screen. Some negative, some positive. But let's wait and watch what our markets do in the session today. We'll get to that in a bit. What will impact our markets today? One, the positives. Let's talk about the positives first. Firstly, the US market move, as I said, which may aid sentiment, so the world peace remains fairly benign. If indeed there is a higher than expected rate action happening, then that should augur well for the sentiment today. And if indeed the commentary from the MPC is dovish as well, then that too should be really big positive for the Indian markets. Add to that the one key monitorable, and that is crude, flirting with bear market territory or in bear market territory. You can argue whichever, but if you just look at the chart, it shows you that crude has indeed slipped into the bear market territory. It corrected about $3 or $4 in trade yesterday, 3 or 4% in trade yesterday after the stockpiles went up. But essentially, this is a chart that is very pleasing to the eyes of any India bull. Crude prices coming off tend to have a very big positive impact on the sentiment and the eventual performance of the market as well. Good for the macro too. So this is one big positive as well. The one negative or the one hiccup in the session today, and arguably one of the biggest monitorables before the policy comes in, is what's the impact that DHFL, the delayed payment, has on the sentiment. Now, I'll talk about that in detail, but simply put, the wholesale lending NBFCs will be under pressure in the session today, so you've got to watch out for those stocks. And banks with exposure to Diwan Housing Finance may also see an impact. Again, the Morgan Stanley notes puts the number at about 38,500 crores, and let's see if those are under pressure. They may be impacted sentimentally, mind you, because DHFL might pay back, and I'll talk about all of that. But for today's session and for the intermediate term, there should be some bit of pressure on each of these indices as well. The SGX Nifty showing that, that number of 12,041. So we're likely to start off in and around decently positive territories. So what's happening there is interesting to watch. But the more important thing is what do specific stocks do in the session today. So firstly, Diwan Housing Finance, that's one big one. Rating agencies have downgraded the company, the commercial paper downgraded by CRISIL and ICRA to D. Liquidity constraints behind the downgrade. This stock certainly should see some action in the session today. More negative news for Bharat Forge and Ramkrishna Forgings. The Class 8 truck orders, the preliminary orders have fallen 70%. Now, I know a number of times the managements have been on record saying that it doesn't impact the companies too much, but I would reckon that there should be some action that we should see on the prices in the session today. Aurobindo, the Hyderabad facility in focus, it's gotten the Form 483 with 10 observations from the US FDA. Yes, the company is saying the observations are repetitive and procedural, but on a day when the sentiment isn't the most positive for certain companies, maybe Aurobindo could see some action. As also Eros International, where CARE has revised the ratings, the long and short-term facilities revised to a default rating. Let's wait and watch what happens to Eros International today. And lastly, for GAIL, PNGRB has hiked the tariffs for GAIL. For example, the Hazira Vijaypur Jagdishpur pipeline rate has been hiked by 71.5%. These are steep hikes that have come in. Do watch out for GAIL. I urge you to go onto the website and read that story as well for more details. Somit will come in and speak about this as well. But this is the other big monitorable in the session today. So lots of stocks which could react negatively, a couple of them which could react positively. But the world is a happy place, and that's what we start off for a bit later on in the show today. We'll get in Michael Every to talk about all of that. But let's tell you what's lined up on First Word today. Firstly, Ira will join us to take us to the factors that might influence the 6 MPC members' decision today. I then take you through what's exactly happened at DHFL, and then Yash Johnson to take us through the impact that this has already had on mutual funds and could have on mutual funds as well. We end First Word with Vishwanath telling us just how much public sector banks wrote off in the last financial year. First up, the 6-member Monetary Policy Committee will declare their decision on key rates today. The MPC, which is meeting for the third time in 2019, is expected to announce another rate cut, keeping the falling growth rate in mind. What else could be influencing the decision? Ira Duggal gets the answer.
India's Monetary Policy Committee is expected to deliver a third consecutive interest rate cut when it announces its decision on Thursday. Before we go into the economic rationale, let's tell you what the Bloomberg poll is suggesting. A poll of 36 economists suggests that 27 of them are expecting an interest rate cut of 25 basis points. 7 economists are saying there'll be a status quo on rates. 1 is saying that there'll be a 35 basis point cut. That 35 basis point cut emerges from commentary from the RBI governor a few months back, which questioned why we only stick to 25 or 50 basis point rate moves. Why can't we think out of the box? He asked. So at least one economist is convinced that a 35 basis point cut is the right thing to do right now. One economist is saying that you need a 50 basis point cut. What is the expectation? The expectation is built on the growth numbers largely because, as you know, growth has been weak and it's been weakening. We got a 5.8% GDP print for the fourth quarter of FY19, but it's not so much about that quarter alone. It's about the fact that growth has fallen from 8% in the first quarter of FY19 to 5.8%. So the judgment that the MPC needs to make is whether there are causes that are slowing the economy which need to be addressed via monetary policy. Let me explain. For instance, if rural demand is a problem, then perhaps the MPC could judge that the PM Kisan Yojana is already addressing some of those issues. Also, if investment is what led to that 5.8% GDP number in Q4, then perhaps the MPC could judge that some of that was due to pre-election uncertainty. So the MPC will weigh where the growth slowdown is coming from, how much of it is durable, how much of it is idiosyncratic and could sort itself out, and only then decide whether another interest rate cut is needed. The committee may be divided once again. We've been seeing that for the last few meetings, so I wouldn't expect a consensus call this time around either, unless there is a perception that growth is weakening rapidly and needs more monetary support. Should the MPC go in that direction, the inflation scenario will actually be supportive right now. While we have seen headline inflation move up to about 3%, 2.9%, we have also seen core inflation come down for the last few months. That should give the MPC comfort, but also suggest that there is some weakening in demand conditions which is showing up on core inflation. Also, while headline is rising at 3%, it's very well within the MPC's target band of 4 plus minus 2%. Now, apart from growth inflation, there will be a question of liquidity. Remember, the 50 basis point cuts that were announced so far have not transmitted, at least through the banking system, and the reason for that is that liquidity has been extremely tight pretty much throughout, and there's been a clamor in the money markets for more liquidity. Problem is that the money market folks will find it tough to convince the MPC of that need for liquidity, because on Tuesday, going into the policy, liquidity finally turned surplus. So, telling the RBI now that they need to intervene more on liquidity will be a little tough. Nevertheless, they do want the RBI to perhaps give some sort of indication that they're willing to allow liquidity to remain in surplus mode. So far, the RBI has preferred liquidity to remain deficit so that the operative rates in the market remain close to the repo rate, which is what they fix. The bond markets, were a problem until recently, but again, bond yields have come off quite significantly, partly due to global factors and local factors. But it's tough to argue now that those 50 basis point cuts have not transmitted into the bond markets, because yields have come down to 7% from about 740 a month ago. But still, the bond markets would like to see a little bit more than just a 25 basis point cut for this rally to continue. So they would hope that along with a 25 basis point cut, you get at least a stance change to neutral or some sort of indication that the RBI has changed its liquidity framework or its liquidity thinking and is willing to allow surplus liquidity to sustain.
So that's Ira Duggal bringing that perspective. I can tell you very, very safely, I'm not a bond market expert, but if indeed it's only at 25 basis points, then you might well see the yields reacting in a different fashion than what they have been doing in the recent past. I think the bond markets are pricing in, as Ira rightly said, or at least the bond traders are wanting a number which is slightly more than the 25 basis points. What if he does a 35? That'll be the first of its kind in a really long time, if ever. So I think all of us are watching out for those pieces very, very closely. I think that another thing that all of us would be watching out for is DHFL. Now it's delayed on bond interest payment for the second time. The housing finance company has been grappling with a fund crunch for some time now, as all of us know. They cited a cure period of 7 days to honor all its repayment commitments. Rating agencies in turn have now downgraded the company's NCDs, the commercial paper predominantly to D. So what's happened? In the event, of course, they've delayed the interest payment on NCDs. Look at the verdict by CRISIL and ICRA, at least the one that we have right now, from A4 plus and A4 to D, which is default. Now, what's the rationale? And I've only cited CRISIL out here. ICRA would have similar rationale, but CRISIL says that the reason why they're doing this is because with liquidity inadequate as on date to service the debt and visibility very low on timely fundraising, CRISIL expects the commercial paper to be in default on maturity. Now, amongst the other reasons cited by CRISIL, they have saying that some of DHFL's NCDs have a, the other factor that they are worrying about is acceleration on default. Now, there are some clauses that are put into place, and I'll take you through them as per CRISIL, of course. They're saying that some of DHFL's NCDs have a prepayment clause. What these mean is investors may seek early repayment in case of a default of some of the other instruments. Now, we know that there is not a default or a default done in commercial papers, and they've delayed the interest on commercial papers, as a result of which CRISIL believes that there could be an acceleration of some of the NCDs by investors, and that we haven't seen as yet. If that happens, it could be a bigger problem for Diwan housing. What's next and what's to be monitored when it comes to Diwan housing? Well, remember, there were a couple of stories that came out. Firstly, the 900 crore sale of developer loans, stake sale in Aadhar Housing Finance to Blackstone, a couple of monitorables, and of course, they'll have to finalize the asset sale within 7 days of the cure period if indeed they want to get some money to repay the mutual funds, so that that funding doesn't become an issue for Diwan housing. Now, what does all of this do to the sentiment around Diwan housing? I think that's the other key monitorable, isn't it? One is, of course, what it does to Diwan housing individually. That is the first piece, and then what it does to some of the others. So the impact on the sector, to my mind, one, the delayed payment and the downgrade will impact sentiment. Most definitely for Diwan housing and for the sector. I think NBFCs could face some funding pressure until Diwan housing contains the situation due to risk aversion. Most investors would be risk averse to give loans or give monies to NBFCs afresh. I think the situation was getting resolved or showing some signs of resolution. That has now again turned ugly. So that is one key thing you need to keep in mind. Wholesale lending NBFCs, without a shadow of doubt, will have some pressure. Those stocks too would remain under pressure. So watch out for the likes of Edelweiss, Shriram, some of the others, which depend on wholesale funding in a big way. I think all of those NBFC stocks would remain under pressure today. Banks having Diwan housing exposure also will likely face markdowns. I think most brokerage notes that have come out have said that banks have exposure of close to about 35,000 or 38,000 crores to Diwan housing finance, and therefore those stocks could also remain under pressure. And the event is certainly a negative for debt inflows into mutual funds. In fact, I would presume that there is a risk of outflows from debt mutual fund schemes in the month of June. They may well contain this in the next 3 or 4 days, but I think that investor sentiment has, because of this, gotten impacted, and we might well see some outflows there as well. So a lot of things to monitor, do watch out for those NBFC names, the wholesale NBFCs. They will be under pressure today, and some of the banking stocks too could be under pressure today. But the delay in interest repayments has more repercussions. It's already started reflecting on the net asset values of some of the mutual funds with sizable exposure to DHFL paper. Yash is here to take us through that data. Yash, what is your analysis suggesting?
So you mentioned how there could be outflows in the debt mutual funds, and that is something that we have been seeing now for several months, in fact, Neeraj, and that is what is likely to happen, because most of the fund schemes which we know about that have an exposure to DHFL, they have taken a hit on their NAVs on account of the delay that DHFL has made in order to repay. So let's take a look first at what is the overall mutual fund industry's exposure to DHFL and its subsidiaries, and that number stands at approximately 6,500 crore rupees. Now the breakup of this goes as follows. 850 crores is in the commercial papers of the company, and 5,650 crores is through non-convertible debentures. Now of this, which are the schemes which have the highest exposure as a percentage of their AUM to DHFL and its papers? That includes the likes of UTI Mutual Fund, Reliance Mutual Fund, which both have well in excess of about 1,000 crore rupees. UTI Mutual Fund being the highest with nearly 2,000 crore rupees, followed by Reliance Mutual Fund, which has about 1,200 crores, and then the smaller names which include the likes of Franklin Templeton, Axis Mutual Fund, both of whom have anywhere between 500 to 400 crore rupees, along with L&T Mutual Fund, which round up the list of the top 5 fund houses which have the highest exposure. But moving forward, like I mentioned, most of the mutual fund schemes, they have already started factoring in this, and they have taken a hit on the NAV so as to prevent any form of redemption pressure. The schemes that have the highest exposure as a percentage of their AUM, that includes the likes of DHFL, DHFL Pramerica's schemes, 3 of them, the medium term floating rate fund as well as a short maturity fund, all of whom have in excess of 30%, almost 38% when it comes to the medium term fund, and there the NAVs on a one-day basis have fallen by almost 53%. So their NAV as of the latest June 6 data that is there has fallen by about 52%, 48% for the floating rate fund, and about 13.5%. The other 2 names that include the like of Tata Corporate Bond Fund, Edelweiss, JM Financial Equity Hybrid Fund, Baroda Treasury Advantage Fund, all of them have a sizable exposure, more than 20% in these names, and all of them have taken a huge knock down. Anywhere between 13 to 22% is what the markdown has been in their NAVs over the last one-day period.
Okay, Yash, thanks so much for putting that into perspective. Keep in mind, because the ratings have been downgraded to default, a lot of the markdowns, which were to the tune of 75% of the NAV of the exposure, will now have to further mark down by the remaining 25% as well. So there will be further hits that we'll see in the NAVs of the mutual funds. And we'll talk about this very important phenomenon with Kaustubh Bilarpurkar of Morningstar, who will join us at about 8:30 to talk about the impact on the NAVs of mutual funds and what's next. I think the other big vulnerable, of course, since we're talking about markets and what's happening, is what's happening to global markets. And Michael Every, head of financial markets research for Asia Pacific at Rabobank, joins us right now on the phone line. Michael, good having you. Thank you so much for speaking to us at Bloomberg Quint India. The last 2 days, save for the US-Mexico talks going a bit awry, have been largely decent for the financial markets. The fact that crude prices have fallen doesn't hurt markets like India too. What have you made of the recent moves, and what do you think happens next now?
Well, let's separate, shall we, between the real and the fake, if we will, given that we have a lot of discussions around the world about fake news. The real is the oil price, and that is absolutely, unquestioningly, something that's good for the Indian economy and should be bullish. So no questions about that. That's real. The fake is the general market reaction to the, quite ridiculous U-turn that the US Federal Reserve are making, looking at all the same data that a few months ago had them saying, well, we're going to keep raising rates, now saying, yes, well, we're going to be cutting rates. Because if they are reacting to a shift in the data, it's something we haven't seen yet, which should actually scare us. And if they're merely reacting to the trade tensions, which are continuing to escalate all around the world, well, I'm sorry, I simply don't buy the logic that a breakdown in global supply chains, US-China tension, US-Mexico tension, et cetera, is all suddenly going to go away because we might have another 25 or 50 basis points of interest rate cuts. It's quite ridiculous to compare the two.
Well, I think you make a very important distinction out there. So, Michael, my question to you is, what would you be monitoring from a financial markets perspective in the Asia-Pacific region more closely? The trade talks wherein the expectation is not too high, or the renewed conversation about the Fed being more accommodative than what was believed earlier? What would be the more important parameter?
Well, in the short term, it's going to continue to be the Fed, but I'm someone who tries to look a little bit deeper than that at the underlying things. So you can't deny the fact that if the Fed are now openly talking about cutting rates aggressively and even floating the fact that they'll do QE again, which, by the way, is no surprise. I'm one of the cynics who's been saying all along, how long until we get the next round of Fed QE, rather than that's done and dusted and they'll unwind their balance sheet. I never believed for a moment they could achieve that. That is important. But on an underlying basis, I think that the real world, the real economy impact of the US and China moving towards absolute loggerheads is vastly more important. And that's what you have to differentiate, because on one level you say it's positive that the oil price is lower for India. That's true. On another, there's this universal knee-jerk tick higher in markets when the Fed starts to look more dovish. Yeah, that's good for India too. But this US-China thing, I don't see many scenarios where India doesn't benefit from that. So that can actually be bullish for India against a backdrop where, frankly, I don't see a lot else to be bullish about.
Okay, Michael, actually that was my last question, and that was going to be my question really. India has got these idiosyncratic issues in NBFCs, etc., and all of that, but we have the policy decision by the central bank, which is expected to be dovish. Crude prices, as you mentioned, is the real thing that has happened, and that should be unquestionably positive. But valuations are stretched. Under all circumstances, valuations appear stretched. What's your view on what Indian markets do over the course of the next 6 to 9 odd months? Ceteris paribus, of course.
Well, may I dodge that question by answering in a different way?
Sure.
I don't want to talk specifically about India or specifically about the market, but a more general point is I actually don't look at the equity markets, if I'm blunt. I look at the bond markets. If I want to have any idea about what's going to be happening in the future, I look at the bond market, particularly the US Treasury curve. That tells me so much more about what I need to know about the world, and I would strongly recommend everyone else to follow the same course.
Okay, that's a fair call, Michael. Excuse me for that, but I appreciate you joining in and giving us your overview on what the recent signs tell us about what the world markets might be going through. Thank you so much for taking the time out. So that's Michael Every of Rabobank. Interestingly, he believes that the crude price fall should be positive, but doesn't quite believe in the two things that come, any kind of resolution talks between the US and China, or for that matter, what happens, or what the Fed will do based on the comments that have come out in the last 2 days. They certainly have taken the markets higher. However, the last piece on First Word, and that's on the Indian banking system, which has been going through a cleanup drive, and it's not quite over yet. Data compiled by Bloomberg show that the public sector banks collectively wrote off nearly 25% of the total gross non-performing assets held by them in the last financial year. What does one make of it? Vishwanath Nair is here with the answer. Vishy, you can look at it as a cleanup drive so that the worst is out of the system, or you can look at it the other way, that, oh my God, they had to clean up so much, and who knows what's next.
That's the point, right? So, Neeraj, what we understand is now, this is obviously all data that the banks put out on their own. So, going by that, about 1.94 lakh crore worth of loans were written off in FY19 alone. This is much higher than what about 1.25 lakh crore loans that were written off in the previous year. Now, you must remember once that for banks, they always like to point it out that this is only a technical write-off and it's not really a write-off. The RBI has multiple times very sarcastically noted that there is no such thing as a technical write-off. A write-off is a write-off. But what bankers seem to suggest is that, when you write off an account, you essentially say that this is never going to come back, so let's forget about it and move on with life. But what bankers are saying in this case is a technical write-off is only an accounting exercise, and that eventually they are going to recover it through various means available, especially the Insolvency and Bankruptcy Code, which is taking some time to show those results, but they believe that it will eventually come to our balance sheet, and that will add to our profits in the coming year. Now, talking specifically about SBI, because SBI is the largest bank and also the largest bank to have the largest amount of write-offs during the last financial year, about 59,000 odd crore. So SBI pointed out that, you know, about 17,000 crore that was added in Q4 was only because of 3 large accounts. There was SR Steel, Bhushan Power and Steel, and Alok Industries. This is something the management said while announcing their Q4 results. And they said that this is because there has been a significant delay. People had expected the money to have come by before March 31st, and it didn't. So which is why they're making 100% provision. But eventually, in the next quarter, or this quarter, or probably the next, you will have that money in your bank accounts, and therefore, you know, recovery should happen. That's the banker's logic. Analysts, however, believe that, you know, maybe some of these insolvency accounts you can see some recovery, but on an overall basis, recovery is going to be very, very, very difficult, because there are multiple cases where either there's bad underwriting, or the promoter has not put in enough money, enough skin in the game to run the company. It's all led by bank capital. So in both those cases, you are not going to recover a substantial amount of your loans. What you will end up recovering is probably cases like this, which are in insolvency, which still is a smaller portion of the entire pool than the overall recoverable amount. So that's what the bankers and the analysts are saying at this point in time. But you know, our viewers can check out bank-wise breakup of each bank, how much they have written off during FY19, going to bloombergwind.com. The story is on the website. You can definitely check this out.
Yeah, well, I can understand the skepticism with all that's happening in terms of recoveries and how delayed at times they are. Yeah. Don't bank on the timing, even if you bank on the account. Maybe. Is that a right assessment? I don't know. But yeah, do log on to this story and read more about this. Pretty interesting data crunching. Vishy, thanks so much for bringing that to us. Yeah. Well, that's all that we have on First Word today, but lots more lined up on Indian Open. Kaustubh Billarpurkar, as we said, of Morningstar will join us to talk about how mutual funds will take a hit due to the DHFL's delay in interest payments. Then discuss markets and macros with Gautam Shah of JM Financial. He'll talk about the charts and what did the charts indicate, and then talk about the expectations out of the RBI monetary policy review today with Anand Bagri of RBL Bank. After this break, though, a full tilt towards the day's trade.